U.S. Federal Reserve officials speaking on Monday took on cautiously the ramifications of the latest downgrade of the U.S. government's credit rating and unsettled market conditions as they continue to navigate a very uncertain economy environment. Fed Vice Chair Philip Jefferson said the latest downgrade by Moody's will be put in the same perspective that we do with all incoming information.
The focus is still on what are the implications of this in terms of the Fed achieving its mandated goals without commenting on what that downgrade might mean in sort of a political economy context. While not an imminent issue for the Fed, over time, higher market borrowing costs tied to a deteriorating U.S. financial position make credit generally more expensive and create restraint on economic activity. In turn, that becomes a consideration for how the Fed sets monetary policy and its expectations for the longer-run path of economic activity. Meanwhile, Atlanta Fed President Raphael Bostic said the downgrade will have implications for the cost of capital and a bunch of other things, and so it could have a ripple through the economy. While concerns about the government's financial position have existed for years and Fed officials have regularly warned that long-run borrowing trends have been on an unsustainable path, ongoing huge levels of spending, joined with a Republican budget plan now under consideration that's likely to add even more debt, are raising fears of a nearing crisis.